Hey gang, Dennis Tubbergen here with another economic update. Today is Wednesday, April 11, 2018. Just a couple of really quick facts for you today. Even though the economic news that you hear for the most part is positive, there's some things going on that you really need to be aware of because things are not as rosy as maybe a lot of political pundits would like to have you believe. John Williams runs a website called Shadow Government Statistic, and it's probably not surprising to anybody watching this that over time, the way the unemployment rate has been calculated, the way the inflation rate is calculated, those calculations have all been modified, and when they've been modified to look more favorable, not surprisingly. Now, if you take a look at the unemployment rate, the red line on this chart from Mr. Williams' site shows you the official unemployment rate. The official unemployment rate is less than 5%. However, if you calculate the unemployment rate the way that they calculated the unemployment rate prior to all these modifications in the way the rate is calculated were made, then we've got an unemployment rate of 21.7%. Now, that particular unemployment rate does something that's quite unique. It counts everybody as unemployed who's not working rather than sorting through the labor force and saying, well, you're not part of the labor force. So we have an unemployment rate that's over 20% when you calculate it the way it was calculated back in the 1920s, 1930s. Our unemployment rate is about where it was at that point. Now, for those that say that we are not in a recession or approaching a recession, I would throw this chart out. This chart is a chart from the Federal Reserve Bank of St. Louis. And if you take a look at the heading on this chart, it's delinquencies on all loans and leases to consumers, credit cards, and all commercial banks. So basically, recessions occur when private sector debt gets too high. And when private sector debt gets too high, simply payments cannot be made on the debt and delinquencies go up. That's what happened back in the recession here in the early 2000s when the tech stock bubble corrected. That's what happened here when we went into an official recession in 2008. And if you take a look right now, you'll see that these delinquencies are going up again. In fact, when we went into this official recession in the first quarter of 2008, and of course, whenever we go into a recession, the economic analysts don't say, hey, we're in a recession now. These are always identified with the help of hindsight. They can say, hey, we went into a recession then, because this economic data is always revised at least 2 or 3 times. But the point here is that in the first quarter of 2008, delinquency levels were at 16,331. Currently 19,472. So delinquencies on loans and leases are about 20% higher than they were at the beginning of the last recession. So I would argue that we're approaching that again. And then when one takes a look again at Mr. Williams' website, Shadow Government Statistics, and you take a look at GDP, gross domestic product, which is really economic output, the official GDP presently is growth rate is somewhere over 2%. However, if you take a look at the inflation adjusted number, and just to read what's on Mr. Williams' site here, the GDP headline number refers to the most recent quarter's annualized quarter-to-quarter rate of change. This can mean the latest quarter can be reported with a positive annualized growth rate, while the actual annual rate of change is negative. This was the same case in the third quarter of 2009. So my point in today's economic update is that I believe that if we are not in a recession today, we are very close to getting back into a recession. That will likely mean, again, as we have been warning, that asset values will take a hit. That's today's economic update. It's April 11, 2018, and I'm Dennis Tubbergen.